In today's video, I'm going to share 5 proven strategies we use to thrive when the market is booming. As a certified financial planner, I've guided countless clients through all kinds of market cycles, and knowing how to navigate a soaring market can be just as important as knowing what to do in a crashing market. So let's dive into the first strategy, which is avoiding the hype. This is really important because every time the stock market reaches an all-time high, there's an investing guru out there warning everybody that the market is at the top and a market crash is just around the corner. While we all know bear markets do happen, they're nearly impossible to accurately predict. So to give you some perspective, let's look at the new highs happen in clusters chart. Looking at this chart, since 1957, there have been 1,186 all-time highs, with many of these occurring in clusters. In fact, 7% of all trading days since 1957 closed at an all-time high, meaning a new high was reached every 14 trading days on average. So should you worry about buying in at the peak? If you're a long-term investor, the answer is no. Even if you've had the worst timing and invested right before a market crash, your returns would still be positive if you held on and stayed invested up until 2021. It would have been a wild ride through the highs and the lows, but you would still end up positive in the long run. The next strategy is to dollar cost average into a diversified portfolio. We would automate our investments by setting up a system where you regularly invest a set amount daily, weekly, or bi-weekly, no matter what the market is doing. So this approach helps you avoid the emotional roller coaster of trying to time the market. So you could have $50 or $200 a week or every other week going into your portfolio and being invested without you having to do anything. The key is to pick an investment amount that you're comfortable with, so you can be consistent over a long period of time. If you start feeling uneasy because prices keep rising and you're buying in the market at higher levels, reduce your purchase size by 10 to 20%, but continue investing consistently. It's easy to talk yourself into stopping, especially when the market keeps going up, because in the back of your head, you're thinking you should wait for a drop and then get back in. But that drop may not come anytime soon. And this is how many investors end up sitting on the sidelines and miss out on participating in long bull market runs. I remember talking to people around 2012 and 2015, 2015 to 2017, and here, 2019 to 2021, urging them to keep investing because no one knew where the top would be. And look where we're at now, almost 5,800 on the S&P 500 index. So by dollar cost averaging, you're riding the momentum without worrying about catching the exact peaks and valleys of the market. Strategy number 3 is rebalancing your portfolio. As markets soar, your portfolio can drift from its target allocation, often with stocks taking up a larger share. Rebalancing means selling some of the outperforming assets and reallocating funds to the assets that are underperforming, like bonds, to realign your portfolio with your risk tolerance. For example, if your target was a 60-40 stock to bond allocation and your stocks grew, your portfolio might now be a 70-30. To rebalance, you'd sell some of the stock gains and buy bonds to get back to your original strategy. This isn't just about risk management, it's also a great way to systematically capture profits. You can rebalance on a regular calendar schedule, quarterly, biannually, or once a year, or use what's called trigger-based rebalancing, adjusting when allocations drift by a set percentage. So whichever method you choose, rebalancing keeps your portfolio aligned with your long-term investment goals. Our fourth strategy is optimizing for taxes. So before rebalancing any of your accounts, understand the type of account you're trading in. Retirement accounts like IRAs and 401ks allow you to sell without any immediate tax consequences, but in brokerage accounts, selling can potentially trigger what's called capital gains taxes. Long-term gains held for over a year benefit from lower tax rates of 0%, 15%, or 20%, all depending on your taxable income. On the other hand, short-term gains are taxed at ordinary income rates, which can range from 10% and be as high as 37%. So to minimize taxes, consider rebalancing more frequently in retirement accounts, like once a quarter, and less often in taxable accounts, sticking to only once or twice a year. If you have realized gains, you can offset them by selling investments at a loss. For example, if you have a $3,000 gain, you can sell a losing portion to offset that gain, potentially avoiding the tax altogether. So, understanding the tax implications of your trades can save you thousands of dollars. So, if you're actively trading or rebalancing in non retirement accounts, just keep track of how everything is netting out the closer you get to the end of the calendar year. Finally, stick to your long term investment strategy. It's easy to get overconfident when the market is soaring. It's also easy to feel scared to invest when the market is soaring. We keep checking our phone, we feel like we're missing out, and we can freak ourselves out. But even if you miss the perfect moment to get into the market or miss out on capturing profit from a stock, remember that staying invested, being disciplined, and consistent with your strategy will be key. Remember, for the majority of our investing dollars, we're in it for the long game. Keep dollar cost averaging, whether the market is up or down, and stay invested for the long haul. With time on your side, the market's natural ups and downs will work in your favor, helping you reach your financial goals. If you enjoyed this video, please subscribe, and I will see you on the next one.